Oh, it says I'm not recording. Okay, let me record the session. Thank you very much. I thought I was recording. Let's carry on with the question. So we've seen that they've given us land, buildings, and computer equipment in the first question. And then we are just having a look at the additional information. So it says land and buildings were purchased 10 years ago. On that date, the buildings were estimated to have a useful life of 30 years and a residual value of 200,000. So both estimates have been confirmed at each subsequent reporting date. Buildings are depreciated using the straight line method. So by 30 September 2018, Docat store traffic had fallen by 95%, and management could not foresee any improvement going forward. They've estimated that they could sell the buildings for 600,000, including an agent's commission of 8%. If they keep using the buildings, they can generate some rental income. So the net present value of these on 30 September 2018 is 550,000. Hopefully this is bringing back some of the work you covered in PPE a few weeks ago. The computer equipment is depreciated as follows. They tell us to use the diminishing balance method, and it was applied at 15% per annum and was acquired on 1st October 2016. With the rapid changes in technology brought on by the fourth industrial revolution, management realized that the diminishing balance method was no longer appropriate. They have estimated on the 30th of September 2018 that the equipment will have a remaining useful life of only 2 years and the residual value will be 5,000. Okay, so that's a lot of information they've given us. Obviously, we need to have a look at what information is important. So whenever you get the question, it's very important to look at the required and understand what are they actually asking us to do. So this required here says provide the property, plant, and equipment reconciliation note to the financial statements of Docat for the reporting period ended 30 September 2018 in compliance with IFRS for SMEs. It says comparatives are not required. Okay, so we understand that we have to provide the property, plant, and equipment reconciliation note, okay? So where do we even start with this question? Okay, so I've put a template here. You know that in your PPE note, you need to have your cost, your accumulated depreciation, your carrying amount. So whatever is going to impact the cost and accumulated depreciation of your PPE needs to be in this note. So things like depreciation, you will have to include in your PPE note. Things like if there's any impairment, then that will need to be included in your PPE note. And remember, you need to show your carrying amount at the beginning of the period and at the end of the period. And how do we determine our carrying amount? This is our cost less our accumulated depreciation. Okay, so are you guys all happy with what we have to do? Okay, we're doing the PPE note. And there may be workings to your PPE note, okay? So if we look at our land and buildings, what can you tell me about the land and buildings? What should the cost be for our, okay, first of all, are we going to show land and buildings in one column in our PPE note, or is it going to be shown in two separate columns? Who can assist me with that? Are we going to show land and buildings together as one item, or do we need to separate them and show them separately? Okay, I agree with you guys. We need to show them separately, okay? So let's look at land first and see what our PPE note column is going to be for land. So if we go back to the information at the top here, they've given us the cost of land of 600,000. Now, it says land and buildings were purchased 10 years ago. Okay, both estimates have been confirmed at each subsequent reporting date. Okay, how are we going to depreciate this land? Who can tell me? Are we going to depreciate this land? Okay, no, you're correct. We're not going to depreciate land. Land will never be depreciated. So, please can you guys just mute yourself in the session unless you ask to be unmuted, and you're welcome to ask a question. So who can tell me what is the cost going to be, our opening cost for land? Okay, I'm not sure if you're aware you're unmuted. Just change that. So what should our land be shown at in cost as the opening balance? Okay, it should be shown at 600,000. Okay, did you guys all get that? Okay, and there's no evidence that more land has been purchased. So do you see that our cost at the end of the period is going to stay the same? Okay, there's no evidence of impairment, so our cost is not going to change. Sorry, there's no evidence of like a revaluation, so our cost is not going to change. So our cost at the beginning and end of the period is going to be 600,000. Now remember when I asked you, should we depreciate our land? You said no. So then does it make sense that our accumulated depreciation is also going to be zero? Okay, there's not going to be any accumulated depreciation on the land. Okay. So if we have a look at our accumulated depreciation, you all agreed that land is not depreciated. So our accumulated depreciation is actually going to be zero. Okay, and there's also no impairment. So our accumulated depreciation at the beginning and end of the period is going to be zero, as is our depreciation. Okay. So if we have a look at our carrying amount, then we have our sorry, is there someone who wants to ask a question? Please can you all mute your mics? Okay, have you all muted your mics? Please mute your mics. Okay, so let's carry on. So if our cost is known as 600,000 and we have all said that our accumulated depreciation is going to be zero, do you agree that our carrying amount is going to be the same as our cost of 600,000? Okay, are you all happy with that? So our cost is 600,000, our accumulated depreciation is zero, which means our carrying amount is going to be 600,000. You said that there was no depreciation on the land, which I agree. And in the question, they don't give us any evidence of impairment. So our carrying amount here is going to be 600,000 as well. Okay. Are you guys, does anyone want to ask a question? You guys can ask a question. Okay, any question? No question. Okay, if you guys have a question and you are struggling with your connection, maybe you could just type your question in the chat box and then I'll assist you and answer the question in the recorded session. Okay, so are you guys all happy with land? There's no depreciation, so land is quite straightforward. I'm sure you all would have gotten that correct. So let's have a look at the buildings. Okay, so if we have a look at the information they give us for the buildings, they've told us there that the buildings are depreciated. Okay, first of all, the buildings were purchased 10 years ago. On that date, the buildings were estimated to have a useful life of 30 years and a residual value of 200,000. Both estimates have been confirmed at each subsequent reporting period. So buildings are depreciated using the straight line method. So then they tell us that on the 30th of September 2018, the store traffic had fallen by 95% and management could not foresee any improvement going forward. Then they give us information here telling us that they've estimated they could sell the buildings for 600,000, including the agent's commission of 8%. But so that is obviously giving us the value if they sold the buildings. So do you agree that is the fair value? They are giving us the fair value there. And then they're also telling us if we use the buildings, they could generate some rentals. So if we are going to keep the building and use it to generate rentals, then that is surely going to be the value in use, okay? So why are they telling us this information, okay? We obviously need to see if there's an impairment. They have told us that the traffic has fallen by 5%, which has indicated that there could be an impairment. So we know that during the current year, we need to assess if there is an impairment, okay? So if we go to our PPE note, what is the opening balance going to be? Have they given us the opening balances for buildings, or do we need to calculate it? Can anyone assist me with the opening balances for building? Okay, yes. So the cost of the building they have given to us at 2.6 million, and then the accumulated depreciation, have they given that to us as well? So they have given us the accumulated depreciation at the beginning of the question as 720,000. So in actual fact, they have given us the opening balances. There was nothing to calculate there. So that was quite straightforward. All you had to do was copy and paste the information given into your PPE note. Okay. But now we'll find that we need to determine the depreciation on the buildings. Okay, so there's evidence of an impairment. They have given us the information here on 30 September. So this information they've given us is at the beginning of the period. Then at the end of the period, they have given us an indication that there is an impairment. So what do we need to do? How do we calculate the impairment? Who can assist me? How do we calculate the impairment, or how do we see if there is an impairment? What are we going to compare on the 30th of September 2018 to see if there is an impairment? What are we going to compare? Okay, we need to compare the carrying amount or the carrying value of buildings to the recoverable amounts. Okay, a lot of you are getting the answer correctly. So if we know there is an evidence of impairment, we need to calculate the carrying value and we need to compare that to the recoverable amount. Okay, so we need to determine the carrying value. That carrying value we calculated in our notes over here. This carrying value is at the beginning of the period, okay? That carrying value was on the 30th of September 2017, okay? But we need to calculate the carrying value on the 30th of September 2018. So we cannot use this carrying value because we need to depreciate the asset for the year and then we need to assess it for an impairment. So how are we going to calculate the depreciation? Can anyone tell me the amount of depreciation? Okay, so these workings are for buildings. We have said that we need to determine the carrying amount before the impairment. And then we need to compare that to the recoverable amount to assess if there is an impairment loss. So in order to get this value over here, we need to first calculate the depreciation for the current year. Who can tell me the value of the depreciation for the current year? So how are we going to determine the depreciation? Remember, the buildings are depreciated at cost. they have a residual value of 200,000. So the cost of the asset is 2.6 million, okay, less the residual value of 200,000. So we've got our cost less our residual value. And what is our useful life for our buildings? The useful life of our buildings was given to us as 30 years. So if we take that into account, what is our depreciation going to be? Okay, do you agree that our depreciation, okay, a few of you got it right there, or actually a lot of you got it right, our depreciation for the current year is going to be 80,000 Rand. How did we calculate that? We calculated that by taking our cost of 2.6 million less the value we expect when we sell the asset of 200,000. And obviously it was a full year that we are depreciating, and the useful life was 30 years. Okay, so our depreciation for the current year is 80,000. Well done to everyone who got it correct. I can tell you have been listening carefully over the last few weeks. So now that we have our depreciation for the current year, we need to calculate the carrying value so we can compare that carrying amount before the impairment date to the recoverable amount. So who can help me and calculate the carrying value just before the impairment happened? How are we going to calculate the carrying value? Surely the carrying value is the cost minus the accumulated depreciation up until that date of impairment. So what was our cost? It was 2.6 million. Now we need to subtract from that cost the accumulated depreciation since we bought the assets until the date of impairment. Okay, a lot of you are getting it correct. So the carrying amount before impairment is 1.8 million. Okay, and how did we calculate that? There's actually two different ways you can calculate that to get to the correct answer. The solution here shows the carrying amount at the beginning of the period of 1.88 million. And then it subtracts the current depreciation, which we just calculated, of 80,000. And that gave us a carrying amount just before the impairment of 1.8 million. But you could have also calculated it this way by taking the cost of 2.6 million less the accumulated depreciation and then less the 80,000 current depreciation for the year. And that would have given you the same carrying value of 1.8 million. Okay, are you guys all happy with that? So we've calculated the carrying value, and I can see a lot of you got that correct. So why are we calculating the carrying value again? Because we need to compare the carrying value to the recoverable amount to assess if there has been an impairment. Okay, now that we've calculated the carrying value, let's have a look at the recoverable amount. Does anyone remember how we calculate the recoverable amount? What is the formula or the method you would have learned in your lectures to calculating the recoverable amount? Can anyone type it in the chat box for me? Okay, how do we calculate the recoverable amount? It's the higher of, okay, it is the higher of fair value less cost to sell or value in use. You are 100% correct. Well done to Zungu, Maleka, and everyone getting the answer right. I can tell you have been listening carefully. So, like you said, we need to take the higher of the fair value less cost to sell or value in use. Do they give us the fair value? If we have a look at the question, what is the fair value of the buildings? They're telling us they estimate they could sell the buildings for 600,000 and that amount includes the agent's commission of 8%. So what is our fair value? Okay, is our fair value the 600,000? No, because well, that is the fair value, but we want the fair value less cost to sell. So we're going to take that 600,000 and we're going to subtract the cost to sell, which we have been told is 8%. And then we're going to use that to determine our fair value. So if we have a look at our workings here, our fair value is actually that 600,000 less the 8%. Okay, a lot of you got it correct. I could see you were typing the correct answer in the chat box. Do you agree the fair value is 600,000, but obviously we need to take out the commission, the selling costs, which is 8%. So if we times it by 92%, this will give a fair value less cost to sell of 552,000. Okay, you could have gone 600,000 minus 600,000 times 8%, and you would have gotten the same answer. Okay, so that is our fair value less cost to sell. Now we need to calculate what is our value in use. So from the question here, if we go to the information, you can see that if they keep using the buildings, meaning they are keeping it in use, they could generate some rentals. So the net present value of these rentals is 550,000. Okay. Do you agree? Is that our value in use? Okay. Is that our value in use? The 550,000. Yes, I do believe that 550,000 is the value in use. Okay, they have given us the present value of these rentals. So how do we determine the value in use? It would be any future cash flow that we expect to derive, and we would need to present value that because we want the value in use today. Okay, so they have told us that 550,000 is the net present value. Okay. If they had just given us the value in the rentals in the future, we would have had to present value that, but they were kind enough to give us the net present value. So that 550,000, that is the value in use. Now that we have the value in use and the fair value less cost to sell, we can compare the two. And remember when I asked you how we calculated recoverable amounts, you said it was the higher of the fair value, less cost to sell, or the value in use. So which one is higher here? Remember, this was the fair value, less cost to sell of 552,000, or we have the value in use of 550,000. So what is the recoverable amount? Remember, it's the higher of the two. So which is the higher of the two in this situation? Is it the value in use of 550,000, or is it the fair value less cost to sell of 552,000? Okay, clearly the fair value less cost to sell of 552,000, that is the recoverable amount. Well done to everyone who got it correct. So this is the recoverable amount because it is higher than the value in use. Okay, so now that we have our carrying amount, and you told me that the way we assess an impairment loss is to compare the carrying amount just before the impairment to the recoverable amount. So if we compare these two, is there an impairment loss? So we are comparing the carrying amount of our building of 1.8 million to our recoverable amount of 552,000. And I'm asking you, is there an impairment? Okay, most of you are saying yes, which is 100% correct. We have an impairment loss here that we need to provide for. And the impairment loss is the difference between the carrying amount and the recoverable amount. So the impairment loss, if we take the carrying amount and we compare that to the recoverable amount, we'll see that we have an impairment loss, which is the difference between these two, of 1.248. Okay, so that is our impairment loss. Okay, and we will show this in our note. So now that we've determined the depreciation and impairment loss for our buildings, now we can actually show that in the notes. Okay. So if we scroll up to our notes, we stopped when we calculated the carrying amount. So what is the depreciation for buildings for the current year? Remember, we calculated the depreciation for the current year as 80,000. So we're going to put that in our notes to show that our buildings depreciated by 80,000 during the year. Okay. Then remember, we compared our carrying value to the recoverable amount, and we assessed that there was in fact an impairment loss of 1.248. So this impairment loss also needs to go into our note. We need to show everything in our note that is changing our carrying amount, okay? And remember, our carrying amount is our cost less our accumulated depreciation and accumulated impairment loss, okay? So if we have a look at our note, the cost is not actually changing, okay? We didn't have any additions during the year, so the cost of our buildings is not changing. But do you agree that our accumulated depreciation and impairments accounts, this is going to change because we had depreciation of 80,000 and we had an impairment loss of 1.248. So both of these amounts here need to be added to our opening balance of accumulated depreciation. Okay, so if we take our opening balance of accumulated depreciation and we add the depreciation and we add the impairment, what is our accumulated depreciation and impairment closing balance here? Who can assist me? So we are taking the opening balance of our accumulated depreciation, which is 720,000, and we need to add to that our current year depreciation of 80,000 and our impairment of 1.248. Okay, so if we add those all together, we are going to get an accumulated depreciation and impairment amount of 2048. Okay, so I see all of you got it correct. Well done. So now that we have our cost and our accumulated depreciation and impairment amount, now we can calculate our cost. And what is our cost? It is simply the difference between our cost of 2.6 million and our accumulated depreciation and impairment amount, which you calculated correctly as 2048. So what is our carrying amount then? It is 552,000. Okay, you all got it correct. Well done. Okay, so you're happy we've calculated our land and buildings PPE note disclosure. Now all that's left to do is to calculate our computer equipment. Let's have a look at what information they give us. So it says the computer equipment is depreciated as follows. So initially the diminishing balance method was applied, and they told us that it was applied at 15% per annum and was acquired on the 1st of October 2016. Okay, so this asset was acquired on 1st of October 2016. They have given us the balances here for our computer equipment at 30 September 2017. So this carrying amount here is actually the carrying amount 1 year after the computer equipment was purchased. Then they tell us with rapid changes in technology brought on by the fourth industrial revolution, management realized that they needed to change their estimates. So they have estimated that the equipment will now have a remaining useful life of only 2 years on the 30th September 2018. And its residual value will be 5,000. Okay, so what are we going to do in this case? Okay, do you agree we need to account for the cost of our equipment we are trying to fill in our note here, and these changes in our useful life and changes in our residual value, this is going to change the carrying amount of our computer equipment. Okay, so how are we going to deal with this in our books here? Okay, let's have a look first at our opening balances in our notes, because I have a feeling that may assist us. So if we have a look at our opening balances here, we need to determine what is the cost and accumulated depreciation and the carrying amounts over here. This is our opening balances. So we need to determine what is our opening balances over here. So usually the opening balances at 1st of October 2017 would be the same as these balances over here. The problem is they have only given us the carrying amount. So the carrying amount is 1275. So that will be our carrying amount in our notes over here. But do you agree we can't just leave out the cost and the accumulated depreciation in our notes? We actually need to show this, which means we need to calculate it based on the information given. So we've been given the carrying amount, and remember the computer equipment was purchased on the 1st of October 2016, which is essentially 1 year ago. It was 1 year ago that this computer equipment was purchased. We're told that it's depreciated at 15% per annum, okay? So if we have the carrying amount, can we calculate the cost of this computer equipment using the 15% per annum? The depreciation is going to be 15% per annum using the diminishing balance method. However, the asset was purchased 1 year ago before this carrying amount here. So can we determine the cost? Can anyone see a way we can calculate the cost and accumulated depreciation of the computer equipment based on the carrying amount and the depreciation that they've given us, the depreciation rate, which is 15%. Okay, there is a way to do it, and I know that you guys will see it. So we have our carrying amount of 127,500, okay? And we have our depreciation of 15% per annum. So this carrying amount, and I see someone has gotten the answer correct, this carrying amount is the carrying amount after 1 year, okay? So what does this carrying amount represent if we think of it in terms of depreciation? So remember, when we buy an asset, the value is basically 100%. And then as the depreciation goes on, the carrying amount becomes smaller. So what percentage does this carrying amount represent? Surely it represents 85% of the value of the computer equipment. So in order to go from the carrying amount, we need to take this 127,500, and that represents 85% of the value of the original asset, but we are trying to get 100%. So we are going to take this computer equipment, being this carrying amount of the computer equipment, and we're going to divide this by 85%, okay? But then obviously we're trying to get 100%, so then we will multiply that by 100%. So do you agree that once we do that, we will get an original cost of 150,000? Okay, so I'll repeat it again. This carrying amount that you see on the screen, that is the carrying amount at 30 September 2017. How old is this asset at this carrying amount of 127,500? They told us there that the computer equipment was purchased on the 1st of October 2016. So do you agree it was purchased 1 year ago? So from 1st October 2016 to 1st October 2017, this became the carrying amount here of 127,500. Okay, so do you agree this computer equipment here at 30 September 2017, this computer equipment is 1 year old, okay? And we have been given the carrying amount of 127,500. They also told us that the depreciation is going to be 15% per annum on the diminishing balance method, okay? And this was applied from the 1st of October 2016 when the asset was purchased. So if we now think about it, the asset was purchased on 1st of October 2016. We applied the 15% depreciation, and then our cost less our accumulated depreciation after that first year will give us the carrying amount of 127,500. So in actual fact, this cost here, when we bought the asset, okay, our cost is 100%, okay? It's never going to be 100% gain if the asset is depreciated. So our cost is 100%, and this was a year ago. Less our accumulated depreciation for the first year, which was 15%. So what percentage of the original cost does this carrying amount represent, okay? We had our cost a year ago, and it represented 100%. Then we depreciated it by 15%. So we know our carrying amount is our cost less our accumulated depreciation. So if we follow that line of thinking, our carrying amount here, which they have given us, the rand amount for, this is going to represent 85% of the original cost. Okay. So if we want to calculate the cost of our asset, we are going to take this amount being 127,500, and we're going to divide it by 85% to represent 1%, but then we want the full cost, which is 100%. So then we multiply that by 100%. Okay. Are you guys all happy with that? Okay, so we calculated the carrying amount being 85% of the original value. So we divided the 127,500 by 85%, and then we need to times it by 100. And this is going to give us the original cost, which I think most of you got right, which is 150,000. Okay. So let's go to our workings. So we have our cost of computer equipment. And like we all agreed, we took our carrying amount, and this carrying amount represented 85% of the original cost. So in order to get to the cost, we simply divided it by 85%, and we multiplied it by 100%. And that is going to give us 150,000. So now that we have our cost, we can actually calculate our depreciation for 2018. Because remember, what is our aim here? We need to actually, we need to show our computer equipment in our PPE notes, but can we just calculate our depreciation for 2018? Because the estimates have actually changed, okay? So when we have a change, does anyone want to ask a question? Okay, so how do we determine our depreciation? We need to first calculate what is our carrying amount. So remember the steps when we looked at a change in estimate? We said that we need to calculate the carrying amount just before the change in estimate, okay? And then we need to apply our new useful life and our new residual value. So they gave us the carrying amount of 127,500. Okay, this is the carrying amount they gave us. Now, we cannot calculate the depreciation because we need to realize that they now have changed the remaining useful life. As time goes on, we realize more about the computer equipment. So now we have assessed that the equipment, it is more accurate to have a remaining useful life of 2 years from 30 September 2018 and its residual value will be 5,000. So how do we calculate our depreciation for this current period? Okay, we cannot calculate it. We basically, that carrying amount becomes the new cost of the asset. Remember, we covered this in PPE part 2. If you are a bit confused, I think go and revise that. But basically, the carrying amount just before the change in estimate, that becomes the new cost essentially. So in this case, the carrying amount was given to us. So the carrying amount is now 127,500. And this is the amount we are going to calculate the depreciation on, okay? So how are we going to determine our depreciation? Who can tell me what the depreciation is for our computer equipment for 2018? Can anyone help me calculate it? Okay, I see a few people getting it right. Well done. So we need to take our carrying amount just before that date, okay? And then we need to take into account all of the new estimates and new information they have given us, okay? So they have given us the residual value of 5,000 Rand. So you know that when we calculate the depreciation, we will less the residual value, okay? And then we need to decide what is our useful life. So they have told us that the remaining useful life is 2 years from 30 September 2018. But do you agree we are calculating depreciation for the period just before that? So in actual fact, we are going to divide it by 3 years, okay? The useful life on 30 September 2018, from that date going forward, we expect the useful life of the asset to be 2 years, but we still need to account for depreciation for that 1 year before the 30th September 2018. So we're going 1 year before to 2 years after. So in actual fact, for purposes of calculating our depreciation, the useful life is going to be 3 years, okay? So I think all of you got that correct. Well done. Okay, so like I said, just these 3 zeros, that is incorrect. So the new carrying amount or cost of the computer equipment is 127,500. And we need to subtract our residual value, which they have given us, of 500,000, okay? Now, what is our useful life? Okay, maybe I should try draw a diagram. But at what point is the remaining useful life 2 years? So if we have a look here, they're saying on 30 September 2018, the asset has a remaining useful life of 2 years, okay? Do you agree that it's 2 years after 30 September 2018? But what period are we calculating our depreciation for? Our depreciation needs to be calculated for 1 year before this date. So when we calculate our depreciation for the period the year before 30 September 2018, we cannot divide it by 2 years because that is 2 years looking forward. If the useful life is 2 years on 30 September 2018, if we are including 1 more year in for the current year depreciation, when we calculate our depreciation, it is actually looking at it from a 3-year perspective. Okay. Let me see. So if we were to take, so at 30 September, so it looks like, so it says in the question, someone has just asked the question that the diminishing balance method is no longer appropriate. So now we are actually using the cost method, okay? Thanks for bringing that up. That's a good question. Okay, now I need to try to think about how to explain these years, okay? So they are saying at 30 September 2018, the asset has 2 more years, okay? So from 30 September 2018 to 2019, that is 1 year, okay? That's 1 year. Then the asset is going to last for another year from 30 September 2019 to 30 September 2020. Okay, so do you agree that's 2 years? Okay, they're telling us that the useful life from 30 September 2018 is 2 years. So we expect the asset to be in use from 30 September 2018 to 30 September 2020. Do you agree that's 2 years? But we are accounting for depreciation from the 30 September 2017 to the 30th September 2018. So do you agree when we calculate our depreciation for the current year, which is 30 September 2017 to 30 September 2018, we can't divide it by 2 because we're not in this period here. We're not in the period 30 September 2018 to 30 September 2020. We are in the period 30 September 2017 to 30 September 2018. Okay, I'm not sure if that makes sense, but if you have a look at the chat here, I've tried to show you, okay. Remember the 1st of October is essentially the same as 30 September. So it goes September, October. So when we look at the dates, the 30th of September is the same as the 1st of October. Okay, thanks, Maleka. That's a good question. But basically, I'm trying to show you that on the 30th September 2018, we expect the asset to last 2 more years in the future. But we are accounting for depreciation 1 year before that date, okay? So when we calculate the useful life, when we calculate the depreciation, we need to use 3 years, okay? And that will give us a depreciation of 40,833 for the current year. Okay, so let's have a look at our PPE note. Just to revise what we went through, remember we calculated the cost of our computer equipment. We calculated the cost at 150,000. Remember they gave us the carrying amount being 127,500. And then we said this represented 85% of the value. So then we calculated the cost being 100% based on this value. Okay, most of you got the answer right. So then once we have the cost, we can calculate the accumulated depreciation, and then obviously the carrying amount was given to us. Okay. Then remember we calculated that our depreciation for our computer equipment was 40,833 Rand for the current period. We didn't have any impairment for our computer equipment, but we did have a change in the residual value and a change in the useful life. Okay, so what is our cost going to be here? Our closing balance cost. Who can help me? What is our computer equipment cost going to be closing balance? Are you guys still there? Remember our cost is still our cost, okay? So I think you guys are confused. When we had our change in useful life and residual value, we pretend that the carrying amount becomes the cost for purposes of calculating the depreciation going forward, but it's not the true cost, okay? We do that for the depreciation calculation purposes, okay? Our cost would only change here if we had additions during the year. So we have our cost and then our accumulated depreciation at the end of the period. How do we calculate our accumulated depreciation? We are going to take our opening balance of our accumulated depreciation being 22,500, and we are simply going to add our current year depreciation, which was 40,833 Rand. Okay, So once we add those two together, what do you get for your accumulated depreciation? Okay, you are correct. You get 63,333 Rand. Okay. Okay. So now we obviously have our closing costs and our closing accumulated depreciation. So we will simply take off our accumulated depreciation closing balance from our cost, and that will give us our closing carrying amount of 86,667. Okay. So obviously when you're doing your PPE notes, because you have different classes of PPE, you will need to total this. Okay, so I know you can all use your calculators. Okay, so if you take the cost of the land, buildings, and computer equipment, you'll get a total over here. So if you add all three columns, this will be your total column. Okay, and obviously this closing carrying amount, this would be the amount in your statement of financial position that your total PPE is shown at. Okay. Okay, are you guys all happy with the PPE notes? Do you have any questions on this first question? Okay, if you haven't gone through the question, go through it after this session just to make sure you understand where all the numbers come from. I can tell some of you have done the question already because you are quick with your answers. But if you haven't gone through it, I'll put up the solution after the session and then you can go through it, okay? But if you have no questions on that first question, we can move on to our second question. I'll just give you a second to think about any questions you have before we move on to question 2. Okay, no questions. So let's have a look at question 2 then. This also is on PPE. So in this question, Kumo is a newly established property developer with a 30 June reporting date. In order to save on setup costs for the new business, the directors decided the entity would construct its own head office. Okay, so instead of buying the head office, they decided to construct their own. The construction commenced on 1st of September 2016. It was completed on 30 November 2016, and the quantity surveyor issued the certificate of occupation. Okay, I see we have a question on the previous one. Why don't we write the closing cost at 127,500? Okay, because that isn't the closing cost. The cost remains the cost at the beginning. Our cost will only change if we have additions or disposals. Okay. Okay, maybe revise your other questions because they would do the same there. Okay. So yeah, the closing cost is still your cost as your opening balance. It doesn't change, okay, because we're not buying any new assets and we're not disposing of assets. We're just changing the underlying estimates, okay. So let's carry on with this question. If people are still confused, you're welcome to email me and then I'll respond via email just so we don't hold the whole class. So the construction commenced on 1st of September 2016. It was completed on 30 November 2016, and the quantity surveyor issued the certificate of occupation on 1st of January 2017. The building was launched and officially opened to the public on 1st of March 2017. So the following cost schedule details what was spent on the construction and opening of the office. Okay. So we have various costs there that were spent on the construction and opening of the head office. Okay. Then if we go down to the accounting policy information, the directors have correctly classified the head office as PPE and have chosen to measure the building using the revaluation model. They apply the net replacement cost method. They have estimated that the building has a useful life of 20 years, after which it can be sold for 500,000. On 1st of July 2017, an independent real estate agent valued the building at a gross replacement cost of 4 million. The useful life remains unchanged. And they're telling us in this question to ignore current tax and deferred tax. So now that we've had a look at the information given, let's have a look at the required. And remember, it's crucial when you're answering before answering the required, you must understand what they're asking, okay? If you write out information and it is not answering the required, you're actually wasting your time and you're not going to get any marks for that. So make sure you understand the required before you answer anything, okay? So the first required says, prepare a schedule calculating the amount at which the building would be measured by Kumho at initial recognition. If any costs are excluded, indicate these with a 0 in the schedule. Okay, so let's see what you remember. This would have been covered in the first part of PPE. So I've got a schedule here. So this is the information they have given us there. And we need to decide, is it going to be included in the amount at which the building will be measured at initial recognition, okay? So we have all of these costs. We need to decide for each one separately, should they be included in the initial recognition cost or should they be excluded, okay? So let's have a look at acquisition of the land. So should this be included in the building costs of the head office? And here I think you need to look at the required carefully. So what are we actually trying to do? We're trying to calculate the amount at which the building would be measured. So should we include the acquisition of the land? Remember when we did the previous question, we said that they need to be recorded separately, okay? So if we are looking at what needs to be included in the cost of the building, can we include the cost of the land? Okay, and the answer is no. We cannot include the cost of the land because we're trying to calculate the cost of the building, okay? So that will be recorded separately. It would be recorded in your PPE notes in a separate column, okay? So if we have a look at the next cost, being building materials, can we include the building materials in the cost of our building, okay? And that may seem like a trick question. What are we including when we have a self-constructed asset? What costs are we including? Surely it needs to be any directly attributable costs incurred to bring the assets to the location and condition for it to operate as intended by management. Okay, so these are the costs. We need to only include any directly attributable costs and any costs incurred in the construction of an item for PPE. So the building costs, I think you all agreed that yes, this should be included. This should be included when we are trying to determine the initial recognition cost, okay? So yes, that is going to be included. We'll highlight it there. If we look at our labor costs, are we going to include our labor costs as part of the cost of our building? These laborers would have taken the building materials and they would have built our head office. Should these labor costs be included in the cost of our building? Okay, you are correct. Yes, we need to include the labor costs. How are we going to determine our labor costs? They have given us the labor cost per square meter being 3,600. But we need to include the total labor cost. We need to somehow determine what is the total labor cost. They have given us the labor cost per square meter of 3,600 and the size of the building is 500 square meters. So what is the total labor cost going to be included in the cost of our head office. Okay, so yes, you are correct. The total labor cost is going to be 1.8 million. We're going to take the labor cost per square meter being 3,600, and we are going to multiply that by 500 square meters. And that is going to give us a cost of 1.8 million, okay? And we will include that in the cost of our asset. The next cost we need to look at is general staff overheads. Should we include these general staff overheads in the cost of our head office? Okay, a lot of you are saying no. So I want to ask for an explanation because I'm sure other people in the class may be confused. Why will we not include the general staff overheads in the cost of this asset? Okay, I do agree with you that the answer is no. We cannot include these general staff overheads. But what is the reason for that? Who can tell in the chat box what the reason is for not including these general staff overhead costs in the cost of the asset? Can anyone assist me? Okay, I see a few people explaining it nicely. So we cannot include it because it's not directly attributable to the building. Okay, that is correct. They are general costs. They are not direct costs. And we obviously can only include directly attributable costs. Okay, that is what the standard says. So we cannot include these general staff overheads. We will not be including the general staff overheads because, as the name suggests, they are general. Okay, they are not directly attributable to the cost of the asset. Then we have fees to quantity surveyor of 50,000. It says this individual issued a certificate of occupation. Without this, the entity would not be able to use the building. So do we include the cost of 50,000 in the cost of the assets? Okay, you guys are smart. Yes, obviously we're going to include the fees to the quantity surveyor, okay, because it is a directly attributable cost to bring the asset into a condition in order to it for operate as intended by management. So without this certificate, we wouldn't be able to occupy the building and use it as management intended. So yes, the fees to the quantity surveyor are going to be included in the cost of this asset. Then we have transport costs. So the transport costs are for the material and the labor that we use to construct this building. So are we going to include the transport costs in the cost of this asset? Okay, yes, I totally agree with you. These transport costs were necessary. Without the transport costs, the labor and the material would not have arrived at the location. So these were costs that were necessarily incurred. They are directly attributable. Without these costs, the building would not have been built and there wouldn't have been any people to do the building. Okay, there would have been no materials and no laborers. So yes, these transport costs are going to be included in the cost of the asset. Okay, you guys are very smart today. Then let's have a look at the next two costs. Furniture. We have furniture at a cost of 300,000. Are we going to include the cost of this furniture in the assets? Okay, why are we not going to include it? I agree with you all saying no. Why are we not going to include the furniture as part of the cost of the building? Surely the furniture is a separate asset on its own, okay? If, regardless of whether we bought furniture or not, the building is already in a condition intended by management, okay? Even if the building is empty and there's no furniture, it doesn't require furniture in order to be used by management, okay? That furniture would be recognized as a separate asset, okay? So we are not going to include the cost of the furniture in the asset, okay? It's not directly attributable to getting the asset ready for use. We can use the building without it. I totally agree with you. So if we have a look at the launch party, are we going to include the launch party costs in the cost of the building? Perhaps they were so happy that the building was finished, they decided to have a big party for all of their staff. Are we going to include the cost of this party in the cost of the building? Okay, no, we cannot include the launch party cost, okay? We may not include the launch party cost. Maybe it was just an excuse to have a party, but regardless of whether that party took place or not, that building was ready, okay? It was ready to be used by management. The fact that they had a party had nothing to do with the construction of the building. It had nothing to do with getting the building ready, okay? So, based on all of the costs we have said we are going to include, what is the cost of the asset going to be? Okay, so remember we said we could not include the land because it was a separate asset and should be recorded separately. Then we had our building materials, and we said yes, the building materials are directly attributable to the assets, okay? So yes, we included the building materials of 1.2 million. Then we looked at labor, and remember we had to calculate our full labor cost. We used the number of square meters, which was 500,000, and we multiplied that by the cost per square meter. So our labor cost is 1.8 million, and yes, we said because these laborers built our building, we include this in the cost of our asset. Then we had general staff overheads. And we said that these were general costs, and these costs were not directly attributable to the costs incurred to bring the to the location and condition for it to operate as intended by management. So we all agreed that we may not include the general staff overheads in the cost of our asset. Then we looked at the fees to the quantity surveyor, and we said, yes, we need that certificate. We cannot occupy this building without that certificate. So yes, the fees to the quantity surveyor is a necessary cost, and we need to include that cost in the cost of our assets. Then we have our transport costs. Remember, these transport costs were used to transport our building materials and our labor. So yes, without these transport costs, we would not have had any material at the site and no people to build our building. So yes, the transport costs will be included in the cost of the building. Then we had furniture, and we were not sure if this furniture was going to be included in the cost of the asset. But remember we said that this furniture by itself is a separate asset, and regardless of whether there's furniture or not, the building is still ready. So no, we will not include this furniture. Then we had a big launch party to celebrate that the building was finished. And we said that no, this launch party was not necessary. It was probably just an excuse for a party. It didn't have to take place for the building to be ready to be used. Okay. So what is the total cost you are getting? What are we going to record our asset at? Okay, I see a lot of you are getting the answer correct. We are going to include the asset in our PPE note at 3.4 million. Okay. Do you guys have any questions on this part of whether items should be included in the cost of the building? Okay, it wasn't too difficult. You guys seem to know exactly what you had to do. Okay, I see most of you are getting the answer of 3.4 million. So let's have a look. If you're all happy with this, this is the exercise we did to determine whether items will be included in the cost of the building. Someone is asking, do we exclude all overhead costs? Okay. If they are general costs and they cannot be directly attributed to the cost of building this asset, then yes, we would exclude them. But if they tell you that there were overhead costs that were used for the building, then you would include it. But there's no set rule. You need to look at those overheads and determine, are they directly attributable to the building or are they just general costs? Okay. So if they are general staff overheads like here, then it's not directly attributable to the building. They're general staff company overheads. So they could relate to other things in the company, maybe like tea and coffee or something that's not directly attributable to the building. Okay. So if we have a look at the acquisition of the land, someone is asking, why don't we include the acquisition of the land? So remember, the acquisition of the land would be recorded separately, okay? Land is recorded separately to the building, so therefore we cannot include the cost of the land in the cost of the building, but that land would be recorded separately in our PPE notes. Think to the previous exercise we did. We had a separate column for land, and we had a separate column for building, okay? So we need to record them separately. So land will not be depreciated in this situation, whereas the building would be. Okay, so let's carry on to the next part of the question where we look at revaluation. So it says here, assuming the building was initially measured at 3.5 million, calculate the revaluation surplus, if any, and the depreciation expense that would be recognized in the accounting records for the reporting period ended 30 June 2018. Okay, so they're telling us to use the initial measurement of 3.5 million. So even though we got 3.4 million, they're telling us to use 3.5 million so that if you got the previous answer wrong, you won't be penalized going forward, okay? So it's important that you read carefully here. You need to use the information they are telling you to use. So assume the building was initially measured at 3.5. We need to calculate the revaluation surplus, if any, and the depreciation expense, okay? So now that it's clear what they are telling us, we also need to look at the period. So they are asking us to record the revaluation surplus and the depreciation expense for the period ending 30 June 2018. Okay, so when was the asset brought into use? When was this? It's the same asset they are talking about. So we need to first ask ourselves, when was this asset brought into use? When are we starting to depreciate this asset? So they say construction commenced on the 1st of September. It was completed on 30 November, but the quantity surveyor issued the certificate of occupation on 1st of January. So when is the date when it is available for use? Not when is it brought into use, when is it available for use? Surely it is only available for use after the quantity surveyor issues the certificate. So what is the date we will start depreciating the asset? Do we start depreciating it only when it was open to the public, i.e. brought into use, or do we depreciate it from the date when it was available for use? Okay, I see a lot of mixed answers here. So if we look at the dates given, it was only available to be used on the 1st of January 2017, okay? So if the quantity surveyor, so it was completed on 30 November, but we could not use it because the quantity surveyor had not issued a certificate of occupation. So we could only occupy it and use it as intended by management on the 1st of January, okay? And then if we look at the 1st of January, it was available for use on this date, but it was only officially opened to the public on the 1st of March. So what is the date we will depreciate this asset? On the 1st of January or only on the 1st of March? Okay, so I agree with you. We are going to depreciate this asset on the 1st of January, okay? So let's just have a look at the information here in the accounting policy paragraph. So it says the directors have correctly classified the head office of PPE and have chosen to measure the building using the revaluation model. Okay, so we're not using the cost model here. We're using the revaluation model, and they apply the net replacement cost method. They have estimated that the building has a useful life of 20 years, after which it could be sold for 500,000. So we are going to record this asset in our books, okay, and start depreciating it from the 1st of January 2017. On the 1st of July 2017, an independent real estate agent valued the building at a gross replacement cost of 4 million. The useful life remains unchanged. Okay, so it says ignore current tax and deferred tax. So we are using the revaluation model here. In what situation would we have a revaluation surplus? How do we calculate in this situation if there is going to be a revaluation surplus on the 1st of January 2017? So they have told us that an independent real estate agent valued the building at a gross replacement value of 4 million. How are we going to determine at that date whether there is a revaluation surplus or not? Can anyone assist me? So I'm asking you, when is there a revaluation surplus? Okay, so when do we calculate a revaluation surplus? We would have to compare the carrying amount of the asset just before that date, and we would have to compare it to the net replacement cost. Okay, they have told you here that we are applying the net replacement cost method, so we will only be able to determine if there is a revaluation surplus if we are comparing the carrying amount of the item of PPE to the net replacement cost. Okay, so let's start with the carrying amount. Remember the date we need to determine if there's a revaluation surplus. We need to have a look at that on the 30th of June 2018. So in the middle of the year, the independent real estate agent said that the gross replacement value was 4 million. So at this date, we need to determine the carrying amount and we need to compare that to the net replacement cost. They are only giving us the gross replacement cost, so somehow we will need to change that into the net replacement cost. But let's for now determine the carrying amount at the 1st of July 2017. Do you agree that the 1st of July 2017, how many months is that into the year? So remember, we agreed in the previous part of the question that the asset was available for use on the 1st of January 2017. So how are we going to get from the original cost, which they told us to use, of 3.5 million, how are we going to get from the original cost to the carrying amount? We need to depreciate the assets, okay? And I see a lot of you are thinking ahead. You know that it is 6 months in the year that this independent value came about. So we go January, so from 1st of January, that's 1 month, January, February, March, April, May, June. Okay, so it's 6 months into the year. So we need to provide for depreciation for 6 months. Okay, so who can tell me what the depreciation is for the first 6 months on this item, on this building? Okay, so these are the workings we are going to do for our building. Remember, we said that we are going to determine if there's a revaluation surplus, and the way we do that is by comparing the carrying amount to the net replacement cost. Before we can get to the carrying amount, though, we need to calculate the depreciation for the first 6 months. Okay, so how are we going to determine the depreciation? Remember, the cost they have told us to use is 3.5 million. They have told us to use 3.5 million. And they told us that they have estimated that the building has a useful life of 20 years and can be sold for R500,000. So how are we going to determine our depreciation for the 6 months? Okay, remember, we are going to take the 3.5 million and we need to subtract the value we expect to sell the asset for at the end of its useful life of R500,000. Okay, and then our useful life is for 20 years. Okay, so we are going to divide by 20 years, and then that will give us depreciation for the full year. But we want the depreciation for 6 months. Okay, so let's do this calculation together in case we get lost. So do you agree the cost is going to be 3.5 million based on what they told us? Okay, so the cost is 3.5 million. And we need to subtract the value, the residual value, at the end of the asset's life. So we're going to subtract the 500,000, being what we expect the asset to be valued at the end of its useful life. And remember, they told us there that the useful life is 20 years. So that is going to give us depreciation for the full year of 150,000. Okay, do you guys agree with that? But the problem we're facing is that halfway through the year, we have a potential revaluation surplus. And we are trying to determine the carrying amount halfway through the year. So the depreciation up until the independent valuation, we need to take that annual amount of 150,000 and we need to divide it by 2. So our depreciation for the 6 months, as correctly said by a lot of you, is going to be 75,000. Okay, so we're only at this stage depreciating the asset for 6 months. Remember, we're trying to determine the carrying amount halfway through the year. Okay, so how do we determine our carrying amount? Remember, it is our cost less our depreciation, okay, or accumulated depreciation. Because the asset was only brought into use on the 1st of January, we don't really have depreciation from prior years. We just have the depreciation for the 6 months. So we take our cost of 3.5 million, which they told us to use, and we subtract the value we expect at the end of the asset's life, okay? And the useful life was 20 years. And that will give us an annual depreciation amount. But we are trying to determine what is the depreciation for 6 months. Okay, where's the 5 million coming from? Someone is asking about 5 million. Let's have a look at the question. So the 500,000 is the value we expect at the end of the asset's life. So the 3.5 million, remember they told us in the required, it says here, assume the building was initially measured at 3.5 million. So that is given to you in the required, which is why it's important to read your required. So remember in the first part, we actually calculated the cost of the building as 3.4 million, but they are telling you here to use 3.5 in case you made a mistake in that first part. You wouldn't be penalized if you're all starting with 3.5. Okay, sorry, what did I do? Okay, I don't know what's happening there. Let's just try and zoom it quickly. Okay, so let's carry on with our calculation here. Okay, who can assist me with Zungu's question? Why do we have to subtract the 500,000? So the 500,000, that is the value we expect at the end of the asset's life. So when we calculate our depreciation, we always subtract the residual value. Okay, so let's go back to this calculation and then let's move on to the carrying amount. So the only reason we're calculating the depreciation for the first 6 months is that we want to determine, is there a revaluation surplus? And in order to calculate the revaluation surplus on the 1st of July, we need to determine what is the carrying amount on that date. So what is the carrying amount on the 1st of July? Remember, the 1st of July is the same as 30th of June. So that is 6 months into the year. We're going to take the cost of 3.5 million, which they told us. So we're going to subtract the residual value because we need to calculate the depreciation. So we're going to divide it by 20 years because that is the useful life. And then we realize that we're not trying to determine the depreciation for 1 year. We're trying to determine the depreciation for 6 months. So we're simply going to times by 6, divide by 12, or you could divide by 2. It will give you the same answer of 75,000. So do you agree this is the depreciation for the first 6 months of the year? Now we have our depreciation, we can determine our carrying amount. So in order to calculate our revaluation surplus, we need to calculate our carrying amount on the 1st of July. So who can give me the carrying amount on the 1st of July? Okay, so remember your carrying amount is your cost less your accumulated depreciation. In this situation, our cost is 3.5 million and our depreciation is 75,000. So if we take the cost minus our accumulated depreciation, that will give us a carrying amount of 3.425, which most of you got. Okay, so we're taking our original cost, which we were told to use of 3.5 million, less our depreciation, which we calculated. That will give us a carrying amount on the 1st of July of 3,425,000. Okay, I see all of you got it correct. Now that we have our carrying amount, in order to determine our revaluation surplus, we need to determine what our net replacement cost is. Okay, now how do we do that? This might be the trickiest part of the question. So they don't give us the net replacement cost. They only give us the gross replacement cost of 4 million. So who can tell me what is the difference between the net replacement cost and the gross replacement cost? If you think back to your PPE lecture last week, there was a slide that explained the value. What is the gross replacement value? Who can type that in the chat box? Because we want to know, how do we go from the gross replacement value to the net replacement value? In order to understand how we go from the gross replacement value to the net replacement value, we need to understand what are these two terms. So who can tell me what is the gross replacement value? You can unmute your mic if it's too much to type. If you think you know what the gross replacement value is, please can you either type it in the chat box or you can unmute your mic.
On the day that you bought it.
Thank you. That is 100% correct. So in the slides last week, you would have learned that the gross replacement value is what the asset should have cost when we bought it. Okay, so now that you understand that the gross replacement value is what the asset should have cost when we bought it, how do we get from the gross replacement value to our net replacement value? So what is our net replacement value then? So the net replacement value would be what the asset's carrying value should be at that specific date. So we need to take the gross replacement value and we need to determine what the net replacement value is from the gross replacement value. Okay. Remember that we also, when we are calculating the net replacement value, we also take into account what the residual value is. Okay. So we also need to take into account what the residual value is when we are going from the gross replacement value to the net replacement value. So if we go down to the calculation, so who can tell me what the net replacement cost is? How are we going to determine this? Okay, I see there are some answers already that are similar, but not exactly what I'm looking for. So remember I said that you also need to take into account what the residual value is when you are determining the net replacement cost. So the net replacement cost is basically, it is the asset's carrying value. So we're going to take the gross replacement value of 4 million. That is what the asset should have cost when we bought it. So this is actually the cost on the 1st of January. But we need to calculate the net replacement cost. So this gross replacement cost is what the asset should have cost when we bought it. In this case, the asset was made, it was not bought, but it was brought into use on the 1st of January. So this is basically what the building is worth on the 1st of January. But we are trying to determine the revaluation surplus on the 1st of July. So we need to take that gross replacement value and we need to subtract what the depreciation is for that asset based on the gross replacement value to get the net replacement value. Okay, so this is how we're going to do it. We're going to take the gross replacement value. You all agreed that this is what the asset would be worth on the date that it was bought, okay? So do you agree this asset was brought into use on the 1st of January? So the gross replacement value, this is what the asset cost on the 1st of January. But we need to get the net replacement value. So this gross replacement value relates to the 1st of January. But remember, since the 1st of January, we have 6 months worth of depreciation. So we're going to take this gross replacement value, and remember I said this relates to the 1st of January, but we're trying to determine what would it have been on the 30th of June or 1st of July. It's the same thing. So we need to subtract our depreciation based on this gross replacement value to give us the net replacement value. So we do that by determining our depreciation for the 6 months based on the gross replacement value. Okay, and this might be confusing and I might need to explain it again, but that's fine. So how do we determine the net replacement value. I don't know, I see one person has got it right. Bento, yours is kind of right. Remember, yeah, yours is actually right. Bento, can you explain your calculation there? You can unmute your mic if you want. Are you able to explain your calculation? Okay, sounds like we may have lost Bento. But basically, we're going to take the gross replacement value of 4 million, and then we need to subtract the depreciation that would have been incurred on that 4 million for the 6 months to bring that gross replacement value to the net replacement value at 1st of July. So we're going to take the gross replacement of 4 million, that is like our cost, and we're going to subtract the depreciation on that gross replacement value to get the net replacement cost. So to calculate our depreciation on the gross replacement value, we take 4 million minus the residual value of 500,000, okay, divided by our useful life of 20 years. But obviously that depreciation based on the gross replacement value was for 6 months, okay. So that is going to give you a net replacement cost of 3,912,500. Okay. You guys agree with that amount? Remember, we're trying to determine the net replacement cost, but they've only given us the gross replacement value. And we agreed that that gross replacement value is what the asset should have cost when we bought it. So the asset was brought into use on the 1st of January, which is the date we essentially got that asset. So that gross replacement value was 4 million on the 1st of January, because it's the cost of when the asset was brought into use. But so we need to go from that gross replacement value on the 1st of January to the net replacement cost on the 30th of June 2017. And the way we do that is to take the value of that asset, being the gross replacement value, and ask ourselves, well, what would the carrying amount of this asset be at 1st of July 2017? Okay, so we're trying to get the net replacement cost on 1st of January 2017. The independent real estate agent valued the building at the gross replacement cost of 4 million. So this gross replacement cost of 4 million, it doesn't relate to the value at the 1st of July 2017, because we said the gross replacement value is what the asset should have cost when we bought it. So the asset should have cost 4 million when it was brought into use on the 1st of January. So we cannot use this as our net replacement value, because this is what the value was when we started using the asset on the 1st of January. So we need to realize, in order to get to our net replacement cost from the gross replacement cost, we need to provide for 6 months worth of depreciation on the gross replacement cost, which is what we've essentially done here in the solution and in the chat. So there are different ways you can calculate this, but you'll get the same answer if you're applying the principles correctly. So essentially, to get from the gross replacement cost to the net replacement cost, we're going to take our gross replacement value, which is essentially what the asset would have cost at the beginning when it was purchased, okay? But we need to get the net replacement cost with the carrying amount. This is the asset's carrying value at a specific date. Our specific date is 6 months in the year, being 30 June 2017, okay? So we need to provide for depreciation on the gross replacement cost. So we'll take our gross replacement cost less our residual value of 500,000. And remember, our useful life is 20 years, but we are not doing a full year's worth of depreciation. We are only doing 6 months. Okay, so let's go through it. Let's see what answer we get, and then we'll explain it once more. So if you are doing your calculation correctly, you'll get 3,912,500. Okay, so do you guys agree the gross replacement cost is 4 million? Do you agree this is what the asset would have cost when we bought the asset? Okay, when did the asset be purchased, or in this case made? Okay, like I said, there are many ways to do it. I think to not confuse you, let's just look at one way, and then once you understand one way, then we'll look at the other methods. Okay, so let's just look at this method for now. There are many ways to skin a cat, okay? So there's many ways we can calculate the net replacement cost. Let's use something that's very logical and easy to understand. So the difference between our gross replacement value and net replacement value, what is the difference? The gross replacement value, this is what the asset would have cost when we bought it. So do you agree this gross replacement value was given to us halfway through the year? But this is the gross replacement value. This represents what the asset would have cost when we bought it, okay? When did we bring the asset into use? We brought the asset into use on the 1st of January 2017. So this 4 million represented the cost of the asset at 1st of January 2017. Okay, remember we were told to use it. We brought the asset, this building, into use for 3.5 million, but the gross replacement value on the 1st of January 2017 is 4 million. Okay, this is not the net replacement cost. This is the gross replacement cost, which is what the asset was valued when we bought it. In order to get from the gross replacement cost to the net replacement cost, we need to provide for depreciation on the gross replacement value. So if the asset was valued at the gross replacement value on the 1st of January 2017, we need to realize to get to the net replacement cost, we need to depreciate this asset for 6 months, okay? So we're going to take the gross replacement value, 4 million, and we're going to provide depreciation for 6 months. Just like we provided for depreciation in the carrying amount, we need to provide for depreciation in the gross replacement value so that the values we have here are at the same point in time, okay? We need to make sure the carrying amount and the net replacement cost is at the same point in time. Otherwise, the revaluation surplus we calculate is going to be incorrect. So remember, when we calculated the carrying amount, we took the original cost of 3.5 million less the accumulated depreciation for 6 months. And we got the carrying amount at 1st of July 2017. In the same way, to calculate the net replacement cost, which is the asset's carrying value at a specific date, we are going to take the gross replacement value of 4 million of January, and we're going to depreciate it for 6 months, okay? When we depreciate it, we need to take into account the residual value. That slide you went through last week, which has the steps, it says they take into account the residual value. The residual value is 500,000 in this case. So when we calculate our depreciation on the gross replacement value, we're going to go 4 million minus our residual value of 500,000 divided by 20, because that is our useful life. and they said there that the useful life doesn't change. And then we're going to change that to be for 6 months. So because the depreciation would be for a year, but we are only trying to calculate the value at 1st of July, which is 6 months after that date, we're going to times it by 6 and divide by 12. Okay, like I said, there are different ways you can calculate it. You could use months. Okay, someone is asking, aren't we supposed to multiply the gross replacement value with remaining useful life and divide by total life? Yes, that is another way you can do it, okay? But you obviously haven't taken into account the residual value in your calculation. So you would need to take into account the residual value. This is the calculation that makes most sense to me, okay? So this is the one I'm showing you. But like I've said, there are different ways you can do it, okay? So the net replacement cost on the 1st of July is 3,912,500, and we are comparing that to the carrying amount, okay? So I think for a moment there we got lost in how to calculate replacement cost, but we need to remember what is our objective here. We are trying to determine the revaluation surplus, okay? So the revaluation surplus is calculated by taking the carrying amount on the 1st of July and comparing that to the net replacement cost on the 1st of July. So if we compare the carrying amount on the 1st of July to the net replacement cost on the 1st of July, what is there a revaluation surplus? So remember, when there's a residual value, have a look at Bento's calculation. When there's a residual value, you need to make sure you're accounting for it correctly. Okay. Okay. But let's carry on. So what is the revaluation surplus? I think a few people are getting it right. We're simply comparing our carrying amount at 1st of July, which is 3,425, and we are comparing that to the net replacement cost being 3,912,500. So because our carrying amount is lower than our net replacement cost, do you agree that we have a revaluation surplus? So our revaluation surplus is the amount by which our net replacement cost is exceeding our carrying amount. So our revaluation surplus is 487,500, okay? Then we need to calculate our depreciation for the remainder of the year. So do you agree that we calculated our carrying amount and then we revalued our property to our net replacement cost? So the amount we are going to be calculating our depreciation on is the net replacement cost, which is 3.91250. Okay, so the depreciation for the last 6 months of the year is going to be based on the net replacement cost of 3,912,500. So if we take that, remember in the question they might have mentioned that our residual value stayed the same. The useful life remains unchanged. And then we have our residual value of 500,000. So when we calculate our depreciation, we're going to take our net replacement value, which we calculated, and we're going to minus the residual value. So our residual value was 500,000. Then we need to divide it by our remaining useful life, okay? So we are trying to calculate our depreciation for 2018. Let's have a look. So took the residual net replacement cost 100. Do you guys agree with that? So because we are now depreciating the asset 6 months into that 20 years, the useful life is 19.5 years. So our depreciation then is 175,000. Let me just check the required. So they are asking us to calculate the depreciation expense that would have been recognized in the accounting records of Kumho for the period ended 30 June 2018. So our depreciation for 2018, based on our new net replacement cost, is 175,000 for 2018. Okay. Are you guys happy now? Okay, well, that is the end of the question. So we've calculated the residual value, and we were happy that there was a revaluation surplus. And then based on the net replacement cost, we were able to calculate the new depreciation after the revaluation. Okay, so that is it from me, guys. Our session is ending in a few minutes. I'm going to put these answers on Blackboard so you guys can go through it again in your own time, okay? You guys have a practical class later today on PPE, which is maybe why you struggled a bit with the last part. But if you are having trouble with the last part, being the revaluation, which you covered in part 3, then I suggest you attend the practical class and listen extra careful, and then I'm sure you will go through it again there, okay? You would have covered the revaluation part in part 3, and your practical is later this afternoon, okay? So please attend that if you're struggling with the revaluation part. Do you guys have any final questions that you want to ask before we stop recording? So that 19.5, that is the remaining useful life. Remember, it was 20 years from the 1st of January 2017, and then 6 months into that period, we had the revaluation surplus. So at that point, you're taking 6 months away from 20 years. At that point, when the revaluation happened, your remaining useful life was 19.5 years. So at the beginning, 1st of January, it was 20 years. So when the asset was brought into use, your remaining useful life was 20 years. And then 6 months into that period, you had a revaluation. So on the date when you revalued your asset, going forward, you will calculate your depreciation as 19.5 years because 6 months have already gone. Okay, so that's how you get the 19.5. It is basically 20 years minus 6 months. Yes, correct. 20 years minus half a year, basically. So the test next week, yes, you need to study everything you have done. I just couldn't find any past questions on the work you did in Unit 1. but everything is examinable, what you have done. So don't spot, because you will come short. You need to study everything you have done, okay? Otherwise, you won't do well. All the best, guys, for your assessment next week. I won't see you before then, but all the best. Please study hard and do your best. Stay calm, don't panic, just do your best, okay? That is it from me, guys. The tutorial session, sorry. I the other lecturer who is in charge of the tutorial session. So in the practical class, you'll just ask if there's been any outcome on the tutorial sessions. And I'll be thinking of you next week, okay? That is it from me. Bye, everyone.
Ma'am, can I ask? Hi, ma'am. Who is I?
Yes?
Hi, ma'am. I was asking about Sage. Are we still going to do it this year?
Hello.
Because we didn't do it last year. Can you hear me? I was asking about Sage.
I can hear you. Can you hear me?
Yeah, I can hear you.
I'm not actually sure what the plan is for Sage. I'm not sure what the plan is at this stage, I'll be honest. I wasn't here last year when you were supposed to do it. Maybe you could just ask one of the other lecturers. I'll also email them and just asking what the plan is for Sage, because I'm not 100% sure at this stage. But I think just go through the work you've done. If Sage comes along in the future, we'll obviously let you know and give you warning, okay?
Okay, thank you.
Okay, bye.